A global view from the IMF. Right now, this is a joy. William Lee has been a good friend of this program with his wonderful perspective, unique perspective on Hong Kong, his service to the International Monetary Fund, his work at Citigroup, and now helping Mr. Milken at the Milken Institute as their chief economist. He will have a panel as well today for Milken, including the wonderful Brian Sack, and Dr. Al-Arian, I believe, will stop by as well. And you will have a virtual pin drop, because in that panel, they will actually discuss the scope and scale of what's needed. Bill Lee, to me, this is the elephant in the room. We're barely talking about, as a percent of GDP, the amount of financial assistance that will be needed to get through this. How far off are we right now?
Well, the numbers that we're talking about, at least here in the United States, are in the 1 to 2 trillion. And I think most people's guesses are actually you need a lot more than that, possibly 3. But you know, Tom, it's not how much, it's where it's going and who's getting it. Right now, the failure of both monetary and fiscal policy in the U.S. is that the money isn't getting to the right people. Businesses that are starved for cash don't have enough. And the Fed has relied on the banking system and as well to administer, and has gone to people who don't need it.
Bill Lee, you do institutional economics like no one. Who do we blame? I'm not going to blame the central bank. I mean, the Federal Reserve was not made in 1912, rather, to do this. I'm mixing up my centuries, folks. This is what happens with age. In 1912, the Fed, you know, they're not supposed to do this. Even the McChesney-Martin Fed's not supposed to do this. Where's the government?
Well, the Powell Fed has actually volunteered to do some of this, and it's failed to do that. It said we're going to put up a special lending program for Main Street. No one's taken it up because they really haven't set the criteria right to get it to small businesses. But Treasury really should, and the regulators have to be more innovative and allow the financial markets to really disperse funds the way its expertise allows it to, which is to find the best uses for money. Instead, they relied on the banking system and bureaucratic SBA, Small Business Administration, to do that kind of distribution, and that's where I think we've gone wrong.
Okay, so Bill, when will that change?
Wow, I think no one's really recognizing that, and I think they're just going to stay with the same old procedures. In fact, they've now just said, let's try to revamp the Main Street lending and maybe get it down to smaller businesses, but still the Fed has to be guaranteed that they get paid back. The bank has to be guaranteed to get paid back. And that means that that innovative business that's about to go out of business, but they're saying we're going to revamp ourselves and create more remote facilities, more digitalization, adapt new technologies. No one's willing to lend to this guy unless, of course, you're going to lend equity. If you're going to be part of that guy's business, you're going to say, do the best you can and make a lot of money. And that's where private equity, private financing can come in, and we haven't gone there yet.
Bill, in general, we talk about, you know, the COVID crisis being a big reset for the world economy, the COVID crisis being, you know, a general just rethink of how things work. And, you know, to your point, no one's really looking at what you've just laid out. Is anything actually going to change once the crisis is over and we're in a recovery phase?
Well, I hope that what will change is a much faster adaptation to the new technologies that will enable better productivity and more distributed production. The other thing that we should look at is what's going on in the rest of the world. The reshifting of supply chains that has gone on because of the trade tensions is really doing, in some ways, a lot of good to have people rethink what is optimal globalization. Optimal globalization is not specialization of countries, but rather it's a balance of risk and specialization. Right. And that is a lesson that I think all the IMF is going to be discussing for sure. And I think the businesses here in the United States and around the world are starting to reconsider.
At the World Bank, at the IMF, and indeed, Bill Lee, at the Milken Institute, I'm going to guess what's off the record is a discussion of one of your expertises, which is Hong Kong. Give us an update on the new Hong Kong. Is there a new Hong Kong?
The big question is, what does China need? Does it really need an offshore center anymore? Does it need to have a place where rule of law still exists, at least Western law? Does it need a place where businesses can operate in the same set of rules that it has around the world? If indeed China feels that they can go rogue, they can do it themselves, or that they're so big that they truly are the Middle Kingdom, and that status comes back to China, then China's going to say, we don't need Hong Kong. We can take it back and let it become another city. In fact, it could be a suburb of Shenzhen. because Shenzhen is sort of our tech center, and that is going to be where we're going to put the emphasis, because that's where Xi Jinping has gone to make a speech about how great Shenzhen and the new technology and the new wave of China is these days. So China's future and Hong Kong's future is intimately tied together with the view of whether China can start to go it alone as it plans, that China wants to have its new technologies and new banking systems and everything else that is centered around itself. I think the discussion at the IMF is going to be that, well, that's not realistic in a world where we're all doing business according to a well-known and established set of rules, and China really has to start playing that game.
How do the China banks play into this? I mean, there's a huge opaqueness there as well. Do the China banks need Hong Kong as a conduit to the rest of the world?
Well, you used to think that, but now I think they're trying to make Shanghai to be the Chinese financial center, as it were, rather than the onshore financial center. The Chinese banks, I think, have gotten better in terms of their risk management, but to this day, we're not sure how safe that banking system really is because of the amount of state-sponsored enterprises that are getting lending from a lot of the banks. And it's not just at the federal level, it's at the municipal and state and local level where we have to worry about government lending and government-sponsored projects that can go belly up and get covered up fairly quickly.
Wonderful. Bill Lee, thank you so much. William Lee is with the Milken Institute, their chief economist, and really a wonderful panel today with Dr. Alarian and also with Brian Sack of D.E. Shaw. I really look forward to the notes off of that piano as well. Coming up in our next hour on oil.